All right. Are we live? I think we're live. Has the Federal Reserve lost control of the bond market in America? They just cut interest rates 2 days ago, and after they cut interest rates, long-term bond yields and mortgage rates spiked, indicating that the bond market is not really paying any close attention to what the Federal Reserve is doing, and that we could be seeing skyrocketing borrowing costs into the future, even if the Fed decides to cut interest rates. This is something that could cause home prices to go down in the long run. It could cause stock prices to go down in the long run, and you guys need to know about it. So the first thing I want you all to understand, in case you missed the news, right? The Fed cut interest rates for the first time in 9 months earlier this week. So they did a 25% interest rate cut, and they signaled more reductions were to come. However, something very strange happened after this, everyone. After they cut rates, mortgage rates proceeded to spike from 6.1% up to 6.35%. So there was a 20 basis point increase in mortgage rates after the Fed cut interest rates. And this is causing a lot of home buyers and mortgage brokers and realtors to be very confused. Because everyone was told for the last 3 or 4 months that when the Fed cut rates, borrowing costs would plummet and everything would get better. Even the Trump administration was saying things like that. Yet the Fed cut interest rates for the second year in a row, and borrowing costs went up after they cut. This is a serious issue, suggesting that the Federal Reserve doesn't control the long end of the yield curve like they used to, and that potentially your borrowing costs as a consumer are no longer influenced much by Fed policy in the short term, but they're being more influenced by how much debt our government has. Our government keeps increasing the debt and the deficit. The deficit might come in at 1.8, 1.9 trillion this year. The debt's over 35 trillion. That's putting a floor on how low long-term interest rates can go, even as the Fed cuts rates. And this is a new era. We haven't seen anything like this for 30, 40, 50 years. I'm going to explain to you in this video what it means for you as a home buyer and where home prices are going due to this interest rate reversion. But first, I want to talk about home builders. Home builders in America are now flashing a big warning sign. Lennar, the second biggest builder in America, just had their earnings report for Q3. And can you guys guess what happened with Lennar's Q3 earnings report? Was it good? Was it bad? Well, let's take a look. Lennar's Q3 earnings report, according to Barron's, Lennar got a boost from actually owning Opendoor stock. However, the stock is falling. Lennar basically reported that they had missing margins and missing revenue estimates on their conference call. And the big thing you got to pay attention to with Lennar, everyone, who's America's second largest builder, is what they're selling houses for. Lennar has cut their average selling price by 22% over the last 3 years. This graph tracks Lennar's average selling price. Second biggest home builder in America. How much are they selling houses for? It's going to have a big impact on where home prices go more generally. You can see Lennar in the third quarter of 2025 sold homes at 383,000 net of incentives. That's the lowest we've seen in the last 7 years. So the second largest builder in America has now cut prices to the lowest level in 7 years, missed on revenue, missed on earnings, missed on margins. What's going on here in the housing market, everyone? We were told for the last 3 or 4 months that Fed rate cuts, declining mortgage rates, the economy and stock market being strong. We were told that these things were going to boost the housing market, that they were going to boost home buyer demand. Yet that's not happening. Home buyer demand continues to struggle. It continues to even go down in many parts of America. And we just keep seeing the warning signs just pile up one after the other. And if you're still out there as like a denier of the housing market downturn, I really don't know what leg you have left to stand on anymore. Home prices are now going down in half the country on a month-over-month basis. Home sales are at their lowest level in 30 years. Builders, the biggest builders in America, are reporting big earnings and revenue misses. But there's a funny little tidbit about Lennar and the home builders I'm going to tell you about in a second. And it's the fact that even though they're cutting prices a lot, they're actually increasing their order book. And I have some theories about why they're increasing their order book and who's buying some of these builder homes. But first, I want to get back to the interest rate discussion, because so many people in the housing market are so convinced that interest rates are what matters for everything, right? Mortgage rates, rate cuts, you guys have heard it. If you watch YouTube, Instagram, or just read the mainstream news, everyone talks about interest rates. Everyone talks about mortgage rates. So why is the mortgage rate not going down after the Fed cut interest rates? Why is the mortgage rate going up? And I want you all to understand this because it's very important you understand this, that the Fed does not control long-term interest rates and mortgage rates in the way that you think they do. They don't control the long end of the yield curve. And it's very important that you understand this as a home buyer or investor so you can anticipate what's going to happen in the market. And the first thing I want to start with, everyone, is the Fed funds rate. This is the interest rate the Fed sets and controls. They cut it last year by 100 basis points. So there's 100 basis points, 1% of rate cuts last year. Then they just did a 25 basis cut 2 days ago. So that's the interest rate the Fed controls. Pay attention to this so you can understand why mortgage rates are going up even though the Fed cut rates. Well, if we compare the Fed funds rate to mortgage rates, what do we see? The orange line is mortgage rates. The blue line is the Fed funds rate. You could see that, there's actually kind of like a loose correlation going back the last 25 years between the Fed funds rate, the blue line, and the 30-year mortgage rate. Like they're kind of aligned, but there's these periods where they're not aligned at all. Like Fed funds rate was 0 for about a decade, mortgage rates were 4%, right? And we had this period last year where the Fed cut interest rates and then mortgage rates went back up. We could be seeing something similar play out this time around. And the reason this is the case, everyone, is because it's not the Fed funds rate that controls the mortgage rate. Rather, do you know what it is? It's the 10-year Treasury yield. It's the 10-year U.S. Treasury yield, the green line. Look at the correlation here between the green line, the 10-year U.S. Treasury, and the orange line, the 30-year fixed mortgage rate. You can see they're much more correlated than the Fed funds rate. Here's the Fed funds rate. Here's the 10-year Treasury yield. And what you notice is that the 10-year Treasury is a market-based bond yield. It's people buying and selling long-term U.S. bonds in the secondary market. And so this ultimately is what influences mortgage rates. And our government is now producing so much debt, and the deficit's so out of control and is not being fixed by the current presidential administration, unfortunately. They said they would fix it. They're not fixing it. As a result, there's just structurally higher Treasury yields now on the long end of the curve, and that even when the Fed cuts interest rates, it's not causing the long-term bond yields and the mortgage rates to go down. And so that's kind of the quick 101 economics and monetary policy lesson that you all need to understand. The Fed seems to have lost its control of the long end of the yield curve. Now, some people will say that the Fed never really controls the long end of the yield curve, that the long end of the yield curve is like a market-based yield, which it kind of is. However, I would say, generally speaking, the Fed in the past has loose control over it. Like when the Fed cuts, you should expect long-term bond yields to go down. That should be an expectation. That is no longer an expectation because this is the second year in a row this has happened. Second year in a row. If it was just this one time, I'd say, oh, maybe it's an anomaly. Last year, the same exact thing happened. The Fed cut, the bond yields went up, suggesting to me that there was a floor on interest rates on the long end of the curve, and it's going to be hard for mortgage rates to get below 6% unless we have some type of recession. Some type of deflationary recession is likely what's needed to bring interest rates and mortgage rates down. And I actually asked you guys an interesting question. I asked you all the question, and I polled you all, what would you rather have? Would you rather have an economy where the unemployment rate's 4.5% and the mortgage rate's 6% and home prices go down a little bit? Would you rather have that economy in scenario A, or would you rather have a scenario B economy, 8.5% unemployment rate, which is like a doubling in unemployment, big recession, 3.5% mortgage rate due to the recession, and home prices dropping 20%. I polled you all on that question. Scenario A, which is status quo, scenario B, recession, deflationary recession. I'm going to show you the results of that poll in a second because it's very interesting to see what you guys as home buyers and investors kind of want to see happen in the market. But one thing that's very interesting to me is home prices and where home prices are going right now. Because home prices are the issue. Interest rates aren't the issue. A 4% long-term Treasury yield, a 6% mortgage rate isn't historically unprecedented, but rather the current prices are historically unprecedented. And what I think is really interesting about Lennar, the second biggest builder in America, folks, is this graph. What is this graph telling us? Their average selling price for Lennar, it peaked at 491 in 2022, and I pulled this from their SEC filings this morning, and now it's 383. So Lennar is selling homes for 22% cheaper and the cheapest they've sold homes for in 7 years. What I think this means, everyone, and you can all let me know what you think, but what I think this means is that Lennar is telling us where the housing market needs to go. Lennar is the one builder that's really getting in front of this downturn. They're cutting prices a lot. I'm going to show you some listings from them in a second that are crazy, how low the prices are. And they're showing you what needs to happen for the housing market to bounce back. Let's take a look at this next graph. Lennar's new order book, the orange line. Lennar's new order book of 23,000 in the quarter is an all-time record. So Lennar is actually selling homes at a pretty fast rate, and their order book is double what it was prior to the pandemic. Look at this, everyone. Lennar's new order book is double what it was prior to the pandemic. Their order backlog has dropped. It's starting to rebound. I don't quite understand, and maybe someone can help me. Maybe someone from Lennar can email me. How does the order backlog drop below pre-pandemic levels, but the new order book rise above? I'm a little confused by that. However, one thing's not debatable. Lennar is selling way more homes today than they were 7 years ago. And the reason they are is because their average selling price, net of incentives, has plummeted. And they're basically like beating the market. They're cutting prices, giving 5% mortgage rates, and people are going to go buy Lennar homes as a result. And what we're seeing is some crazy stuff, everyone. Take a look at this. This is a house in San Antonio from Lennar. Guess how much they're selling it for? $180,000. I mean, folks, there's some crazy prices here across Texas, especially. I think Lennar has cut their price in Texas by like 30%, or in the South Central, they've cut it by over 30%. 180 grand on a 3-bed, 2-bath, 1,200 square foot home. So that's about $150 a foot. But 180 grand in San Antonio, in the city limits. I mean, we haven't seen prices like that in a very long time. What about in Houston? What about in Houston? Well, you could buy a mansion basically from them for 551 grand. That's 3,300 square feet. So 550 divided by 3,300 is that's $166 a foot. They also have, look at this, everyone. They have a house near Houston in a place called Cleveland, Texas. You can let me know if you've heard of Cleveland, Texas. I haven't heard of it before. 212,000, 4-bed, 2-bath, 1,900 square feet. So this is 211,000. We'll just do some math on the fly. That's $112 a foot. They're selling this house for $112 a foot, a 2-story house. Someone in the comments says that's 80% garage. It does look like a big garage, but I don't think it's 80% garage. My overall point here, everyone, is not to say that you should rush out and buy a Lennar home. I'm not saying that at all. What I am saying, though, is you are seeing prices drop in a lot of segments of the market, right? There's these deniers who tell you there is no housing market downturn. And you guys can let me know, like, do you still hear these people saying that? Like, are they still saying that? Well, let's just look at the data. The second biggest home builder in America has cut prices 22%. They have $180,000 homes in San Antonio, $112 a foot near Houston. Prices are dropping and dropping fast in a lot of different parts of America. And what I'm going to do for you right now, actually, is go through some of these markets where prices are dropping most. Because we just updated the data on Reventure app for August 2025, the data from Zillow on home values, and we have some very interesting shifts in the market. Where are prices dropping most? Where are they still going up? I'm going to get into that in just one second here. But I want to actually show you the results of this poll. You know, I polled you guys and I asked the question, what scenario would you rather have? You know, would you rather have, you know, what kind of economy would you rather have? Would you rather have status quo economy, 4.5% unemployment, 6% mortgage rate, 5% drop in home prices a year from now? Or would you rather have a recession, 8.5% unemployment, 3.5% mortgage rate, 20% drop in home prices? 2/3 of you answered, and 7,500 people voted in this poll. 2/3 of you want the recession. 2/3 of you are willing to double the unemployment rate if it means mortgage rates dropping to the mid-threes and home prices dropping by 20%. And I think that's a really interesting I think that's a really interesting thing. Like, two-thirds of you want a recession. Let's actually go into the comment section here in a second. What's going on in the comment sections? I see some of you here. One guy is asking me, don't you get tired of talking about the same thing day in, day out? Absolutely not, actually. So why I don't get tired talking about this, everyone, is because there's so much misinformation in the mainstream news, in the mainstream real estate market, and so many realtors spew so much garbage about the housing market that I feel like it's my job and my duty to get on here and educate people about what's going on, with the market. Um, so yeah. All right, everyone. What else? Jonathan says I'm basically an analyst for the housing market. I get featured a lot. That's true. I do get featured a lot in the news. That's true. Newsweek, CNBC. Where else have I been featured in the news? Wall Street Journal, Bloomberg. Yeah, I've been on all those sites. Fox News Business. Um, Keith Jacobs says it's dumb if you want a recession. Why is that dumb, Keith, if you want a recession? Explain why that's dumb. Because I think the interesting thing here is that if the unemployment rate were to double, well, that means 4% more people don't have a job. So we go from 4% of people not having a job to 8% of people not having a job. So, I mean, that's a big increase in unemployment, but only 4% of people won't have a job. But then everyone would get the benefit of 3.5% mortgage rates, a 20% drop in home prices. You actually need to have recessions. And if you don't have recessions, you have a problem in your economy, right? We haven't had a major recession in this economy in 16 years. And someone says my audio sounds like I'm underwater. I apologize about that. Let's see if I can fix that. Can I fix that right now? Let's see. Guys, I apologize if the audio is bad. I don't know why it's bad, but we're just going to try to muscle through this if you guys are okay with that. Or I'm going to try to move the microphone closer to here so we can try to make this a little bit better. Is that a little bit better? You guys can let me know if that's a little bit better. All right. All right, let's see. What else? What else are you saying in the comment section, everyone? All right, Nicole closed on her home. Congratulations. Congratulations for closing on your home, Nicole. Someone else says the audio sounds good. So some of you saying the audio doesn't sound good. Some of you saying it does sound good. Just a little bit echoey, I guess. So let's dig into some of the data, everyone, on where home values are going, because I think it's really important you understand what's actually going on in the market. As I was saying, why do I talk so much about, similar topics on a weekly basis? Why do I talk so much about the home builders struggling? Why do I talk so much about, the interest rates not really going down or the rate cuts not really having an impact? So you guys can understand what's going on in the market as a home buyer. So you guys can understand what's going on in the market as a home buyer. And we could see actually in the last month, half of the states in the U.S. had declining home values in the last month. Half the states in the U.S. These states in blue all had declining home values in the last month. This is according to data from Zillow available on ReventureApp. So I was telling you folks, oh, there is no housing market downturn, home prices are still going up. Not true in half the country. These areas in blue have declining prices. The areas in red have increasing values. So the Midwest and the Northeast is still seeing upward momentum in August 2025. The Southeast, Southwest, and Pacific is seeing downward pressure on home values on a month-over-month basis. So we still have this bifurcated housing market, right? Where, if you are in the Northeast, Midwest, you're going to still see bidding wars in some pockets. If you are in Texas or Florida, you're going to see declining home values. And in Florida, Florida's where values dropped the most last month. So in Florida, they dropped 0.65% on the month. 0.65% on the month in Florida. Let's zoom in on this so you guys can see it. In the last year in Florida, they're down 5.1%. So Florida is still experiencing a housing correction. Florida is still experiencing that correction. Washington, D.C. is experiencing a housing correction. Now Nevada is even getting in on the action. Prices in Nevada are still flat year over year, but they're now going down on a month-over-month basis. Arizona is seeing a housing correction. Interestingly, Maine is now popping up on month-over-month declines. Mississippi, Texas, Hawaii, Kentucky, California. These are the 10 states where values dropped most in the last month. You can see values also dropped in South Carolina, Vermont, Colorado, Georgia, Tennessee, Louisiana, Alabama, Montana, New Mexico, and North Carolina. Where did home values go up the most the last month? They went up the most in Kansas, Alaska, Connecticut, Iowa, Illinois, New York, North Dakota, Wyoming, Ohio, and Minnesota. So pretty much Northeast, Midwest, plus Alaska is where values went up the most over the last month. Someone in the comment section says Pennsylvania needs to start dropping. Chris in the comment section, yeah, that is true. Pennsylvania is still holding on strong. We actually got a request, everyone. I'm going to take a quick little request here if you guys don't mind. Zip code request, Weston, Florida. Weston, Florida. 33332. Wow, we got 4 threes in the zip code. That's a lot of threes. Let's see. Why is this zip code not dropping? Dominique says higher income, high demand. Well, let's see. Let's see what's going on here in 3332, Weston, Florida. So first thing, home values are dropping in this zip code. They dropped 0.86% in the last month, which is a pretty big drop. That annualizes to over 10% in a year. In the last 12 months, values are flat. So you are correct to say in the last 12 months, prices are stable. However, month over month, they are accelerating in terms of their decline. And the reason is likely, let's see, is it inventory? Is it price cuts? Let's take a look at the inventory in the zip code. And this is the type of analysis that you guys should perform for yourself. So inventory is actually not that high in this zip code. It's just gotten back to the long-term average. Just gotten back to the long-term average. So our forecast for this zip code is actually stable prices, believe it or not. It seems like maybe there's some recent downward pressure the last 3 months, but we actually think there's going to be stable prices in this zip code due to a shortage of supply. It's not really demand. If you look at the home sales are really low. The demand is actually way down in Weston, Florida, if you look at the home sales, but the inventory is still not high enough to bring people back into the market. The inventory is still not high enough to bring people back into the market. What else? Eric has an interesting comment. He's saying it all depends on who's being touched by a recession. If you work in an industry that's fairly recession-proof, then you're more likely to be okay with a recession and lower mortgage rates. I think that's an interesting point, right? So if someone's a realtor, I don't know if you want a recession if you're a realtor. I know I have realtors watching this channel. Do you guys want a recession? Do you not want a recession? Probably the best thing that could happen for housing demand and home sales is for prices to drop. I think a recession would actually cause an increase in demand in the long run. But yeah, maybe if someone's in tech, they might not want a recession. I think if someone loves staring at their 401k every week and looking at their 401k and seeing their 401k go up, they probably don't want a recession. I think there's a lot of people in America that are like that now, who basically kind of like stare at their stock market portfolio every day and have gotten used to it going up so much. They probably don't want a recession because their net worth would go down. Someone who's a doctor, right, might not care about a recession, to your point. It's like a doctor's not going to lose their job. A dentist is not going to lose their job. People in construction, maybe it's in between. Some people in single family construction might not have as much work, might not make as much money. So that's an interesting point. It like really depends on like who you are and where your money comes from and what you do for a living on if you would want a recession, not want a recession. Let's see, let's get some more requests, everyone, because I think, in the context of what we're talking about here, right? Fed cutting rates, these rate cuts not doing anything, mortgage rates going up. Okay, so it doesn't seem like we're going to get saved by interest rates. At the same time, the home builders like Lennar are signaling to us that, the values are probably going to drop more in the future because of how much they've cut the price, right? If Lennar's cut the price 22% in, your neighborhood, good luck trying to resell that house and not getting along with those price cuts. So what's going on with prices, right? I think this is one thing I want you guys to understand. Where could prices head in your market? Because that's ultimately where affordability is going to have to come from, is prices. Prices are at an all-time high still on a national basis. They are starting to go down, but they're still near an all-time high. They're still too expensive. So where would prices be most likely to drop? Let's take a look at some requests here and dig into it, everyone. Chris also has a good point. He's saying when a painful recession happens, you can't always predict where the damage spreads to. Even if you're not in a good position, everyone in your family may not be. I would say the one thing is like, you wouldn't want a recession to hit the banking sector. You don't want banks to go under, right? Like that would be bad if banks started going under and people started losing like their deposits. No one wants that. But I think, unemployment rate going up to 7 or 8%, some of the excess getting cleared, asset values going down could be healthy in the long run, could establish a lower rate of inflation, make things more affordable for everyone. All right, let's see. How about Scottsdale? Now, folks, if you have ever been to Phoenix, you've probably at least heard about Scottsdale. Scottsdale is kind of like the Beverly Hills of Phoenix, right? This is where, we see downtown Phoenix right here on Reventure app. Scottsdale is just to the east, northeast, and this is where the wealthy people live in the Phoenix metro. Actually, Paradise Valley, I should actually say, is the Beverly Hills of Phoenix. Median income of $200,000 in Paradise Valley. In Scottsdale, the income's around 100,000. And what are home prices doing here? Well, in Scottsdale, values are down 3.8% in the last year. In Tempe, they're down 4% in the last year. But folks, this is actually kind of funny. In Paradise Valley, prices are up 10% in the last year. So again, Paradise Valley, the Beverly Hills of Phoenix, typical home value of $2.9 million. Wow, 2.9 million. I mean, that's crazy. 2.9 million. You go a little bit south, it's 370,000. So this is where the really wealthy people in Phoenix live. A lot of people from California moved to Paradise Valley. 10% increase in prices in the last year. That's nuts. What's the Reventure forecast here for Paradise Valley? Reventure forecast is up 5.2%. So I'm going to say, folks, the Reventure forecast called this. If we actually look at the Reventure forecast a year ago in Paradise Valley, it was a 55 out of 100. We called this a buyer's market a year ago. What happened? Prices went up 10%. We think values are going to go up another 5% in the next year. However, we think values are going to drop in most other parts of Phoenix. We have a big downward forecast in a lot of different parts of Phoenix. Go to www.reventure.app at the end of this video if you want to see the downward forecast in your market. If there is a downward forecast, maybe it's an upward forecast. You got to know this 1 year forecast, everyone, before you buy a house so you can make a more educated decision. How about some other requests, everyone? Tamara actually has a great point. She's talking about Warren Buffett here. Let me actually zoom in on this so you guys can see it. She says that the $3 billion that Buffett has in T-bills is the most amount in cash in Buffett's history. Get ready for when you lose it. So what Tamara is talking about is the fact that Berkshire Hathaway and Warren Buffett is stacking cash. So if you look at Warren Buffett cash holdings, I think it's 348 billion in cash at Berkshire Hathaway. It's their biggest cash pile on record. We look here at Statista, has a graph. You could see, oh my gosh, look at all this cash that Berkshire Hathaway is holding, everyone. This is wild, absolutely wild. Berkshire Hathaway, just a couple years ago, they only had like 50, 70 billion in cash. Now they have 347 billion in cash. I think it's around 25% of their assets. So, to Tamara's point, why is Warren Buffett holding so much cash? What does he see coming that maybe other people don't see? Why is Warren Buffett, it's almost like he's getting prepared to go on a buying spree by holding so much cash. Let's see, what other requests you guys have? Here's a comment from It's Him. He's saying in Phoenix, prices go up in the best areas and down in all the rest. Yeah, Phoenix is a bit of a bifurcated market. I think in most zip codes, though, Phoenix is going down. What about, okay, 90249. This is an interesting request, everyone. 90249. I know this is in California, 90249. The question is, where in California is it? Gardena? No, that's 92048. Oh, here we go, Gardena. So this is south of Los Angeles, everyone. So Los Angeles is actually a very bifurcated housing market. This is what, the second largest metro in America after New York. You can see values are going down in a lot of parts of LA. Values are going down already, right? These areas in blue are where values are already going down in LA. If we go down to Gardena and Compton, we can see values have started to drop year over year. They're not yet like crashing, but we got 3% decline, 2.5% decline, 1% decline. These are areas that were traditionally a bit more, rough around the edges. Some people would say they were a bit hood. Median incomes are definitely a bit lower here in Gardena and Compton, 70 to 80,000, even 60,000 if you go a little higher. So, these areas are still gentrifying. I have some concern for areas like this in a housing market downturn because they tend to get hit harder. In the last crash, this area went down like 40, 50%. in the last crash. You can see 40, 50% declines from 2007 to 2012, southern LA, south central LA. Our 12-month price forecast, though, is a minus 5.5%. So we think values are going to drop minus 5.5% over the next 12 months here. South Central LA, you can see it's turned from a seller's market to a buyer's market. A lot of inventory, a lot of DOM. You should be able to negotiate a good discount on a house here if you are a serious buyer. So yeah, definitely, if you are buying a house here, know that it's a buyer's market. Know that the trends are in your direction, and make sure to negotiate with sellers. Bring them the reventure forecast. Actually, one thing you guys can do, hit download report. I don't know if any of you guys actually know you can do this on Reventure app. Hit report at the top, and you can actually download a market report for your area. And some people have had some success doing this. They download the market report, and then they give it to the seller. They give it to the listing agent and the zip code. And you can see this market report, home price forecast for 90249. Folks, one thing that's actually really annoying, this is Adobe. And look, I use Adobe. I'm a paying customer, but like they bring up their AI assistant automatically every time, and it just slows down the PDF loading. They need to stop that. All these AI assistants just automatically loading when you just want to look at something simple is getting pretty annoying. But you can see here for this zip code 90249, print out the report, 5.5% downward forecast. We have all the substantiation for why the forecast is that way. So it's a great way to actually help yourself get a discount potentially on a house, downloading that market report, giving it to the seller listing agent. All right. What other requests do we have, everyone? Chris has a great point. Chris is saying that insurance, property taxes, and maintaining the property on top of inflation, a lot of people are kind of in trouble keeping things afloat. And so a lot of people are saying, how can you basically afford to own your home, right? How can you afford to keep paying when the property taxes have gone up, when the insurance have gone up? I think this is an issue a lot of sellers are running into, unfortunately. A lot of sellers are running into this issue. And folks, if you're having trouble hearing me, you just got to turn the volume up. I don't know what's going on with my microphone right now. We'll try to address it for the next stream. Home ownership, I think for a lot of people, has turned into something that is a liability, right? Where your ongoing costs are getting so cost prohibitive that the idea of like actually owning the house doesn't feel as good as it used to. You used to buy a house, right? And the property taxes were fairly low. The insurance was fairly low, right? Now you buy a house and you do that calculation on your monthly payment, and all of a sudden, wow, I'm paying $4,000 a month, $3,500 a month with my taxes and my insurance included. It's a level that's getting really hard for a lot of people to afford, particularly in neighborhoods where people don't have as much money. I think that's why we're seeing certain areas go down that are more lower income, like I was just talking about in LA. Let's get some more requests, everyone. All right. How about, we got Antioch, California. Do we have some requests not in California? I'm happy to talk about California, but let's get some other requests. Denver. Let's talk about Denver, everyone. And then where's 77095? 77095. We'll start actually with that one. 77095. I like typing in a zip code that I don't know where it is. All right, it's in Houston. It's in Houston, 77095. So this is interesting. And Houston's actually a really interesting market, everyone, because if you look at our price forecast in Houston, what do you see? You see that certain areas are going down in blue. We actually think most areas are going to go down, but there's certain areas that are actually still holding up. This is almost kind of like Phoenix, and it's almost the exact same situation. You move in here and you look at the median income, and wow, there's some really high income areas southwest of Houston. 227,000 median, 249,000 median in Bel Air. Bel Air is like, again, the Beverly Hills of Houston, like Paradise Valley is the Beverly Hills of Phoenix. Prices in these areas are still going up 4 to 5% a year. Well, look at everywhere else in Houston, everyone. Boy, double-digit declines, 6%, 13%, 6%, 16% drops in certain zip codes around Houston. But then you go to the west side, it's still going up. This map shows you how important it is for you to understand what's going on in your market, right? Like, do not buy a house without looking at this data, because You could be buying in Houston, you hear some realtor or mortgage broker talking about general Houston market metro dynamics. It's not going to be meaningful for you depending on where you are. Are you on the east side? Are you on the west side? It has a huge, huge impact in terms of where things are going. We're in a very bifurcated market. 77095. Let's see. What's going on in 77095? This is Northwest. Prices are down 2.3% in the last year. And then over the next year, we're forecasting minus 3.8%. Minus 3.8% forecasted decline over the next 12 months. So a little bit of a marginal correction in the zip code. We don't think it's going to be a massive crash. There are some areas in Houston where we do think there already is a big downturn. There's going to be a bigger downturn. So make sure to go to www.reventure.app and check your zip code. All right. What about 92346 in Highland, California? 92346 in Highland, California. 92346, Highland, California. All right. So this is where? This is in Riverside Metro, San Bernardino, actually. So this is an area where prices are already dropping 1.1% over the last 12 months. And for those of you that don't know, San Bernardino is kind of just to the east of LA. I actually went to downtown San Bernardino like 2 years ago. Downtown San Bernardino is not the nicest place. This is not in downtown San Bernardino, fortunately. But prices here are still forecast to go down on Reventure app. Our 12-month forecast is minus 3.5%. This is shifted to a buyer's market. Last year was a seller's market. Now it's a buyer's market. Biggest buyer's market we've seen in 9 to 10 years in this zip code. So you should be able to negotiate a discount. That's what this means, everyone. You see that forecast score go down to a 38. You see the minus 3.5%. You should be able to negotiate a discount in an area like this. Let's get some other requests, everyone. I'm on a roll here. Let's get some other requests. How about, Mount Juliet, Hendersonville, folks. So I actually haven't had the chance yet to really talk about Nashville. I moved back to Nashville about a month ago. How are things going in Nashville? Well, we got a big old downward forecast in Nashville. Minus 6.9% over the next 12 months is our downward forecast in Nashville. And folks, you guys let me know what you think. I was actually thinking I was going to actually try out a billboard in Nashville. And I was going to try out putting a billboard. And on the billboard, I was thinking of putting our home prices in Nashville about to crash. Go to www.reventure.app to check the forecast for your zip code. That's what I was thinking I was going to put on the billboard. I don't know if that's too sensational. Like, I was thinking like some people might get really upset seeing that on their drive to work every day. But I'm thinking about it. You guys can let me know what you think. But overall in Nashville, we have a minus 6.9% forecast. Let's see. What about Hendersonville, though? So Hendersonville is a nicer suburb to the northeast. In Hendersonville, over the last year, prices are flat. Prices are flat over the last year in Hendersonville. A lot of people want to start a family. They go and buy a house up here. Well, our one-year price forecast is minus 5%. So this has shifted into a buyer's market, everyone, here in Hendersonville. You could see, we were a huge seller's market 4 years ago. Then we kind of went to like neutral. Now we're in a buyer's market. We're in a definite buyer's market. You should be able to get discounts. You should be able to negotiate with sellers. The reason why it's a buyer's market is, one of the reasons is inventory. There's a lot of homes for sale. We now have the highest homes for sale in the market that we've seen in the last decade. The other thing is the DOM. The DOM here, oh my goodness, look at that. DOM at 51 days. Long-term average is 31 days for August. So these houses are just sitting on the market in Hendersonville for the longest they've sat for a decade, indicating that it's going to be better for you as a buyer. And I'm going to get into some more requests in a second, but I just want to run through the data points that matter most, right? Inventory, price cut rate, days on market, home sales. If you know those 4 data points for your zip code, you basically know most of what you need to know about what's going on in your market. Like if you know those 4 data points, you know where demand is, you know where supply is, you know how difficult sellers are, how difficult a time they're having in selling, and how likely they are to cut the price. And what our forecast does on Reventure app is we take all those data points and we package them into one data point that forecasts where values are heading in the next year. And our forecast, everyone, it's performed over 6 times better than Zillow's forecast so far in 2025. I mean, this is kind of crazy, everyone. I knew, we came up with a good forecast here at Reventure, but we actually came up with a page that educates you on what's going on with this forecast. Yeah, here's the comparison to Zillow. from earlier this year. Zillow's on the left, what their forecast was in 2024 to what the prices were in 2025 on the growth. And then here's our forecast on the right. You can see our forecast, our correlation coefficient was 0.72. Zillow's was 0.1. So, as far as I know, Zillow is pretty much one of the only other widely available forecasts for like all the different metros and counties. Our forecast is doing over 6 times better than Zillow's so far in 2025. So this is a forecast you can trust. This is a forecast that's going to help you as a buyer save money on a house, potentially make a more educated decision, decide whether you should buy today or not buy today. And if it is a big downward forecast, use that market report to negotiate with sellers and listings agents so they understand where the market is heading. All right, what else, everyone? I know that there was another super chat. I got to get to that super chat. Let's see here. I apologize, everyone. Sometimes when I do these live streams, it is hard to keep up with all the comments. It is hard to keep up with all the requests. I am doing my best. Someone is asking, why am I at a public library? I'm not in a public library. I'm actually in my office. Does it look like a public library? You can let me know. I guess it's a very studious atmosphere here in my office. What else? I just know there was one super chat that I don't want to miss. Let's see here. Highland, California. Redmond, Washington. All right. SFRZ was Redmond, Washington. All right. 98052. Redmond, Washington. Do you guys know what's going on in Redmond? I believe that's where Microsoft's headquarters is. Is that right? Is Microsoft's headquarters in Redmond? Or is that Xbox maybe? I don't know. Redmond. Yeah, it's basically, no, it's Bellevue Microsoft. Maybe Bellevue is Microsoft. But Redmond's not too far away. Here, the typical value of a house, folks, is $1.3 million. So we're in the Seattle metro. Downtown Seattle's over here, right? And then you go across the Sound. You go across the bay. You get to Bellevue. You get to Kirkland. You get to Redmond. Very expensive part of the country. This is basically California prices. In the last year, in this zip code, prices are flat. So the prices are flat year over year. Where do we think they're going to go in the next 12 months? Whoa, look at this. Minus 7.9% is our forecast at Reventure for the next 12 months for Redmond. Now, why is that? Why is our forecast, why is it so downward? Well, and this is another one, folks, where I'm going to say we predicted this. A year ago, we were at a 48 out of 100 in this zip code, which is basically a neutral, stable forecast, is where we were a year ago, and prices were flat over the last year. In the last 12 months, though, our forecast has dropped to a 28 out of 100 on the score, which is a minus 7.9% price forecast. What's going on? Looks like inventory has shot up through the roof. Inventory has almost quadrupled the last 3 years. We have the highest number of homes for sale going back a decade here in Redmond. So this is a very interesting market. It's one that is flat year over year, right? And we called that last year. We said it was a flat, stable market last year. Our forecast this year has plummeted, meaning that in the next 12 months, we think values are going to be dropping. You should be able to get a discount in this zip code, given how much inventory there is on the market. All right, what else, everyone? How about we take a couple more requests? We have time for a couple more. Crystal says, Redmond is Microsoft, and there are layoffs, thousands laid off. That's a great point. Maybe the Microsoft laid off 10,000 people. Maybe that is causing some of the issues showing up in that housing market. All right, 95350. 95350 is the next request. Where is 95350? Modesto, California. Wow. So we are now, is this Central Valley? Is this technically Central Valley, California? So Modesto, folks, is to the east a couple hours of San Francisco, to the south of Sacramento and Stockton. And this is an area where we are now forecasting declining prices. We're not forecasting a crash over the next year here. We're forecasting some of these markets to go down 0.5%. 95350, 95350. Yeah, we're forecasting 95350 to go down 4.3%. So in the last 12 months, it's down 0.7%. Our forecast in the next 12 months is minus 4.3%. And you can see kind of how our forecast has evolved here. We had a positive forecast last year. This has now shifted significantly into a buyer's market. So this is good news for you if you're a buyer in this zip code. You have a lot more leverage than you did 1 year ago. A lot more homes for sale. Homes are sitting on the market longer. A lot more price cuts here in Modesto. Let's see. What else we got? What else we got? What else we got? Someone says there's a Lennar development near their zip code. Are they doing price cuts? All right. Because Lennar was doing big price cuts on a national basis. I don't know if they're doing price cuts in California. All right. We got Michael with a request in Hawaii. Oahu, Hawaii. Let's see if I can spell that. And let's look at Hawaii. I know I don't talk about Hawaii a lot. I talked about Alaska in the last live stream. Whoa. We got some big downward forecasts here in Hawaii, folks. Look at this. Minus 7%, minus 10%, minus 8%. What is going on here in Hawaii? Why are the prices forecast to drop? What have they done over the last year? Well, over the last year, they're kind of flat to slightly down. Minus 1.7, minus 1.1, flat. And the next 12 months, we're forecasting minus 8, minus 7, minus 10. Why is that? What's going on? Ooh, we've shifted from a crazy seller's market to a big buyer's market. This is wild. This is wild, everyone. Inventory through the roof. Days on market through the roof. Wow. Days on market is typically 31. Now it's 62. You see that, folks? You see days on market doubling in your area from the long-term norm? That's telling you it's a buyer's market. That's telling you you're more likely to see a housing market correction. All right. What else? How about, oh, let's see. I don't think I ate enough food today, folks. I did a workout at lunch, and I had like a kava for lunch. I love kava, but wasn't enough, I don't think. Especially when I do a workout plus the live stream. It's a lot of calories expended. Got to make sure to eat more next time. All right. Do we have any other requests, folks, that you guys want me to take a look at? I saw a request for Miami. I got to take a look at Miami. Folks, Miami is like an interesting market. What's going on in Miami is like, I feel like it's somewhat of an indicator of what's going on, in the broader U.S. economy, broader U.S. housing market. Let's take a look what's going on. 33955. 33955. Is that Miami or is that another part of Florida? 33955. 33955. Oh, no, that's Punta Gorda. That's on the west coast of Florida. You guys want to see like a major crash market? You guys want to see a major crash market? This would be Punta Gorda. West coast of Florida, south of Sarasota. Values here are down 11% year over year in the zip code that was just requested. They're down 16% year over year in the zip code to the north. Some of you might remember I did some on-the-ground filming in Punta Gorda about a year ago, warning you all of what was coming. Well, a year later, values are down anywhere from 12 to 16% year over year. There's a massive crash going on in Punta Gorda. And over the next year, we think this crash is going to continue, further double-digit declines coming. A lot of home builders here. The demand has dropped. Great news, actually, if you're a home buyer, though. A lot of cheap houses coming onto the market in Punta Gorda. All right. Yolanda says Miami is a box of surprises. That is so true. Miami is a really interesting market. 11753. We actually haven't really had any requests in the northeast yet. 11753. Where is this? Jericho, New York. Where is Jericho, New York? That's on Long Island. All right. Strong Island. What is it? 11753. Oh my goodness, folks. This is our second biggest upward forecast. This is our biggest upward forecast yet in this video. We're forecasting values to go up 8.3% in Jericho. If you were hoping for a discount here, I would say you're going to be sorely disappointed. Values are up 4.6% in the last 12 months. We're forecasting them to go up another 8.3% in the next 12 months. Wow. Why is that? Well, let's look at inventory. Nassau County, New York. Well, Before the pandemic, there was 100 homes for sale, 117 homes for sale here in Long Island. Now there's 33 homes for sale in this zip code. And when you see the inventory this low, you know that prices are going to keep going up. And the days on market is also below the long-term average. So we have DOM below the long-term average, inventory below the long-term average, and then price cuts. Folks, there's no price cuts. 5.7% price cuts, 26% before the pandemic. I hope me going through these requests, if you're watching, you can't request. I hope this is gonna help educate you on how to analyze a housing market, right? If you are someone who's serious about buying this year, and often the deals do get better in the winter. If you are serious about buying this year, you have to look at this data before doing it. Because if you're going to make a purchase for 400, 500, 600,000, maybe 1.3 million if it's in Jericho, New York, you got to understand what's going on in the market and what you're facing. If you're in that type of zip code that still has an 8% upward forecast, you know that waiting isn't really going to get you a whole lot, right? Waiting isn't going to get you a whole lot. Prices are likely to be higher in a year. Conversely, if you're in a zip code like Punta Gorda, Florida, where the forecast is minus 10%, where values have already dropped by 10%, you're saying to yourself, I can get a discount, I can get a deal if I buy now. I should negotiate hard. So what I would encourage you guys to do, go to www.reventure.app. I would actually say it's an absolute necessity. If you are looking at buying a house this year, if you're looking at studying up and buying in 2026, you got to go to Reventure app and look at those key data points. Look at those key data points on price cuts, on inventory, on days on market, and then you're going to want to check out our forward 12-month price forecast. This is the most reliable, widely available price forecast you're going to find on the internet for the housing market. And the way you can gain access to that forecast is sign up for a premium plan. The premium plan is $49 a month, which is, depending where you are, about 0.01% of the cost of buying a house. Ultimately, a very affordable price to gain peace of mind about where home prices are heading in your market. You can even use this data in certain areas to negotiate cheaper purchase prices. Some people have negotiated $40,000, $50,000, $60,000 discounts using the Reventure app forecast. Additionally, if you know you're going to be looking for an extended period, sign up for the annual pass. That gets you a 32% discount to the monthly rate. You're going to have all the data at your fingertips for your housing market. For the national housing market, actually, you'll have access to national data as well as our market reports. And, I hope you guys enjoyed this video. I think the Fed cutting rates and then mortgage rates going up is telling you a lot about where the housing market is right now. We're not going to get saved by mortgage rates. The only way the housing market is going to get saved is by lower prices. Lennar is proving that point. Lennar has cut prices 22% from peak. Their order book is through the roof compared to what it was five or 6 years ago. So people will buy if prices drop enough.